I'm sure Mary knows about it too, but I want to hear how was Mary's experience with investing with Rod and Robert.
Okay, so I invested in their Dallas one, and it only started in May, but they started payouts right away, as opposed to like invested in some of Neil's, and he doesn't, like where they're new builds, you don't get any payout for a year and a half or 2 years. And the Dallas one is doing better than expected. I think they've got this really great property manager. It was a value add, and it's 100% filled. So they had kind of estimated 50% vacancies. So they estimated the first year that it would get average like 6%ish, but it's, the last payment was at a 10% rate. Now it's only two, they pay you quarterly. So they're going above, but it's only been 6 months. So it's new.
Oh, that's nice. So they
already paid 10%. That's great.
Yeah, they paid. I think the first one they paid like 8%, so it was 2%, an annualized 8%. So the first one they paid 2% in third quarter, and the fourth quarter they paid 2.5%.
I see. Got it. And then was it like what type of class is that? B or C or anything?
I don't know if it's B or C. I think maybe it's B minus going to B plus.
Okay.
Something like that. I think they've done weird things like I think they hadn't opened the pool. I mean, it's Dallas, for heaven's sakes, and they didn't open the pool last year, the prior year when somebody else owned it. So, anyway, I think they found some good things to add.
Right.
That's great.
And do you know, like for that deal, what is the split? And then what's the spread?
The split is, hold up. Can I share my screen? I have I don't know. I'm not sure I know how to share it, but I'll open it up and I'll show you what they predicted on it. So it's,
and it looks like James and Vivek also able to join us. Hey guys, I think that's pretty much it. Hey.
Hello. How is everyone doing?
Doing all right.
Can't see your face though.
Nice to see you guys.
Yeah, I'm still on my way back from work home, so I'm outside and it looks all distracting and everything. So I thought it'd be best for everybody to turn it off.
Yeah, nice of you to join us.
Congrats on your newborn.
Okay.
So Mary, you can just click on the share button. Okay, great.
So this is the one for the Dallas deal with Rod. So this is their prediction. And
9% cash on cash, and then 13%.
So yeah, they expected first year 5.1%, but they're probably up to 8 or 9% annualized. But we only got 6 months for the payments, of course. So.
Right. Are they doing a refi or something in year 4? Because that's quite a bit of a jump. Okay, that makes sense.
Yeah, right there. That's a refi. Yep.
Oh yeah, I just see that right now. Sorry, small screen.
But what's the split? I can't see it from here.
Oh, I don't know if it says it's 70-30. I don't remember. Some of these guys have it's 70-30. Like this one for Joe Fairless, Ashcroft. It's 70-30 until they get to 13%, and then it's 50-50. I don't remember if this has one of those or not. I just don't remember.
Okay, that's interesting because for the deal we are going to cover, I asked them. They actually had a 50-50 split.
Oh, I noticed. Yeah.
Oh wow, really? Okay, I didn't catch that.
Surprised me because I asked them because they put it in a very small font size in the footnote saying that 8% pref and then 50-50. It's not even like Neubauer. Neubauer said and once we hit the threshold, then we become 50-50. Before that, it's like a 80-20 or 70-30. They just right away jump into 50-50.
This is they're very confident that they can meet all the numbers even at day one, looks like, or year one.
I don't know. All right, so I'm going to share my screen.
Yeah. So Yan has volunteered to be a host the evening, and thank you for doing that.
Yeah, I learned a lot. Although I did it in a hurry. So welcome to discuss everything. So just try to organize the data in a logical way, and then we can discuss more.
Sure.
So how can I, it
Share
says
screen?
not share
Yeah. If
screen.
you hover your mouse all the way to the bottom, and a bar will show up with the
No,
buttons.
it says I cannot start
Oh,
sharing the screen
you
while
might have to. Oh, I see. I see. Let me do that. Now you can see if you can do that. Oh, wait. Maybe
Do I need to unshare, do you
maybe you
think?
have to unshare the. Sorry, I don't
All
figure
right,
all
let me
that.
see if I can figure out how to do that. Let's see.
should be something called stop sharing the screen.
Yeah.
Okay, I'm looking. No, wait, that's Word. Stop share. There we go. Got it.
There you go. Okay.
Share mine.
And we have a mystery caller also.
It's the mystery color.
Who's the mystery caller? Hi.
All right. So so let's just start it. I don't know whether you guys dive into the call. I didn't, but I watched the video after that, and then also read the PDF they send out. I feel really good about it. When I first watched the video, my first impression is that they are very transparent and also very conservative. So I have a very good feeling. But when I get more data, it seems like it's against my first like impression.
Wow.
But we need to discuss more. So I think if you guys read the PDF they send out, so I think it's very straightforward. So this specific property is located in used to be a D area. And this property might be class C-ish or maybe B minus, but they plan to move up to maybe B plus. And the way they do it is that, okay, they said, okay, I'm going to replace the current PM because they're not doing a good job in promoting. So they're going to replace a PM and then also try to add some amenity, try to bring the rent up to the market rent. According to them, it's like a $100 difference. Yeah, so those are the business plan. Although they didn't like detail like what they're going to do, their approach is more like a try and error. So do some renovation and then see how market reacts and then do more. So that's their plan. So these two, I think it's not controversial. So if you look at the demographic trends, it says, okay, so this is actually the.
Oh, hey, Yan, can I stop you for just a minute? Can you zoom into the document a little bit?
Oh, okay. Yep.
Sorry about that.
Is it better now?
Perfect. Yeah, yeah.
Much appreciated.
Okay. Can even make it even bigger. Yeah. So I think I'm showing Cincinnati demographic. And we can also dig deeper into this neighborhood, which I didn't show because I think this is not controversial. So this neighborhood is relatively bad. Household income is like maybe less than 30K. And then a lot of people live like under so in poverty. And then people living there, I think single plus single mom with a kid is like 70% ish. And then 70-80%, I think 70% is black, and then another 20% is white. And the education level is also low. Not a lot of people with a college degree. So those are the facts. I think not controversial. And then what else? So yeah. So starting with this these facts. So let's think about if this deal is going to work. How can we make it work? right? So we don't want to reject this deal only because this is a Class C in Class D neighborhood, right? So we are trying to see how we can make it work. So, okay, so working backwards, so you can either improve NOI or you can buy it cheap, right? So improve NOI, so can we increase the rent? They mentioned that current rent is $100 below the market rent. Is it true? And then can we even increase more by adding some amenity? Okay, can we reduce vacancy? And then can we do two things at the same time? And then can we reduce the expense by replacing the current property manager? And then also I did a little bit case study, what happened to the comps that finished the transaction in most recent 2 years. And then what happened to them for the vacancy and then for the rent increase. Okay, so that's on the NOI improvement side. On the other hand, what happened to the cap rate? Did we buy it really cheap so we have a lot of buffer? And that's, so these two are just a snapshot. It's the current status. But we also want to see, okay, maybe today we buy it just fair, or maybe we overpay for now, but we bet on the future because they constantly mention that, okay, the whole downtown area is up and coming, and then it will benefit this area since it's at the north border of the downtown area. That's what they claim. So is it really true? Can we see the trend? I basically compare the trend in this property, in this or the comps in this submarket in the whole city. So we can see whether they exhibit the same trend. Okay, then we dive in.
That's a really interesting topic. I love to hear you say that because I have no idea how to look at gentrification. Also, before you go to the next question, I just want to, it looks like in the chat room there, Vivek asked the question, why do you think it's a D neighborhood?
Oh, I just quoted. They mentioned this. Actually, if you go to their PowerPoint, they have two places. One, they said this is Class C, but then they also, in one place, they also mentioned this is Class D. So I think probably it's the Class C in the Class D neighborhood. That's what they meant. But they do have inconsistency in their PowerPoint.
Okay.
So that's why I said, okay, I use that as a fact. I didn't make that a judgment. So another reason I said the neighborhood is really bad for sure. The crime rate is high, but I think it's Class C and Class B because according to CoStar, it basically assigned it as a 3-star, so it's relatively high. Yeah. So
so the property in itself might be a Class B or late C.
Yeah.
Jan, can you say that again? The CoStar said it was a what?
So they use different rating system. They classify 1 to 2, 3-star, and then 4 to 5. So this specific property, they said this is 3-star property.
Yeah, so I think CoStar purposely not want to use ABC because it could mean different things, especially when you mix the neighborhood and the property condition, the age of the property. So when I talked to the rep from CoStar, he mentioned that a 3-star building, it's more probably like a Class B building. Yeah, so they try to separate out the actual location. They don't give a star rating for the location. They only give a star rating for the property.
Wait, hold on. So CoStar is giving a rating of the physical building versus the nature?
Yeah, it would be things like amenities and other things as well that are in part of the also the age of the property, but it's related to the property itself, not so much about the location.
Okay, so it's important then also to remember that CoStar is just making that rating at a pretty kind of high level. I mean, it's good for us, but as an example, CoStar doesn't know, if the infrastructure of the building, the systems are, they're not making any kind of evaluation of the systems, et cetera. They're just kind of using age of the building and, amenities, kind of like an Odo or whatever.
Mhm.
Like statistical analysis kind of thing, I would
Okay.
imagine.
Yeah.
Okay. Yeah, and I think the up and coming portion is very important in this case because that's all they claim, right? So because they know right now it looks bad, but they're betting on the future. So I think this is unique in this case.
Mhm.
Then the last question is that, okay, what
And
is
I'm
the,
sorry, how were you able to get a feel for, yes, this neighborhood is gentrifying or it's in the path of progress? I mean, those kinds of things for us out of towners are really hard to know.
so by just looking at the data, I would think even if they claim that eventually the downtown area gentrifying will benefit this, I don't see it in the near future. That's the short conclusion, but we can see it from the data as well.
Hey, Yan.
Mhm.
So when you want, I can give some perspective on this neighborhood in Cincinnati because
Mhm.
my wife, that's where she's from, and
That's perfect.
her family's all there.
Mhm.
But I don't want to interrupt your flow.
No, you can jump in anytime.
Okay, can I jump in?
Yeah, sure.
All right. Okay. So a couple things here, and I'm looking just at like a Google map, but you can also go to the PDF. I think it's page like 7. Okay. Yeah, that's good enough there. So basically, that area historically has been a high crime area.
Yeah.
Oddly, my wife was specific enough to say that there's a lot of crime in those parks.
Mhm.
All that green area, those are parks. Her other comments were that the access is not ideal because you'll see that those like 127 and 27, it's all north and south.
Mhm.
And because of the parks, it's hard to go left and right. So for example, in the PDF, they show a number of like shopping centers or whatever, and other conveniences, but it takes time to get to those. And my wife, her name is Ellie, so I'll just call her Ellie. And she said it, and I said, well, it doesn't look that far. And she said, well, the map doesn't really show it. It's like 6 or 7 miles to kind of circle around. I think that's less of the issue, but. So if I'm getting this right, so north side is it north side? I think it's north side is kind of the is a rough area where a lot of hipsters are, as she put it, but kind of the rougher hipsters, like the ones with nose rings, and maybe artists are there. And I said, well, and then if you go further down on the oh, you've got it right there. On the map where it says Cincinnati Art Museum and below there. That's a great area. That's where this over the Rhine is. It'd be great to find a building there because it's further along in the up and coming. I won't go on about why we want to buy a building in that area, but so my question to her was, well, if there is if and this is a big if there is, compression on rents in, the over the Rhine area, which leads people kind of north, to the north side area, will they go up to Mount Airy? And her view was, it's so far early that you're guessing. Like there's no data to support. There's no, at least the people on the street in Cincinnati, there's no indication to suggest that people are going to flow into Mount Airy. Now, the other thing she said, to be fair, is that, 2 things. One is, so her brother, who's younger than she is, he just turned 40 and he's got a wife and, tons of friends. And she has not heard any of them say, oh, there's a new restaurant or a new this that's opened up in the area where the apartment building is that we're thinking about. but it's also possible that they just haven't heard of anything because they don't really ever go there or hear about it, etc. And so that's kind of consistent with, Yan, you were saying that 70% of like the demographic, if I heard you right, are single mothers with children.
Single mother with the children. Yeah.
Yeah, 70%, right?
Yes.
Yeah, something like that. Okay. So when I said I gave her that demographic statistic, she said, yes, that sounds correct. So from my perspective, and I know we're not in the like necessarily evaluating it, a question I have is, do single mothers with a child care about amenity improvements and care enough about them that they'll pay more rent for those improvements? Because usually single mothers, with a kid, they're just trying to make ends meet, especially in a city like, Cincinnati. And then the other question is, are there people somewhere in the city of Cincinnati that will say, oh, I think I'll move there because it's still not as expensive as some of the cooler parts of Cincinnati, but, some good amenities, so there's some good value there. So that's my overview on, Mount Airy. I'm sure I forgot something to say, but it'll come to me.
That's great.
Yeah. I think that's a first-hand experience, and then it definitely echo with the data.
Well, that's kind of fun, isn't it?
Yeah, absolutely.
Like coming from different perspectives, kind of a boots on the ground, even though she's 100 feet away from me right now, but a boots on the ground and a data analysis arriving at a conclusion. It's kind of similar.
It's
one
tricky.
last thing, but just one last thing. So then I was thinking about, and I don't want to like go on, but so then I was like, I wonder if this is not really so much a value add deal. To your point, Ann, where you're like, did we buy it right? Because if we buy it right, then maybe it's a great cash flow property for single mothers, with a kid, and you've got constant demand, and you provide a clean, safe, basic apartment, situation, and it's just a yield play all day long. You put nothing into it other than safety and paint. I don't know.
Yeah.
Well,
So I talked with Robert I went to the boot camp in LA a few weeks ago, and he said, I said, so what's you're always supposed to ask, what's the theory about getting out? And he said, who cares? We'll refinance and you'll get all your money back. The investors get all the money back, and they just keep, getting cash flow forever, So anyway, that was his answer.
yeah, that might explain why they are pretty weak on the business plan. And to answer Peter's question, they didn't even focus on saying, okay, this is not a value add deal, I just buy it cheap. They didn't mention that as well. I don't have that impression. So
I think they mentioned buying it at a reasonable price. And I think the data show that. But I think to Mary's comment about cash flowing, I think the deal is like pretty strong from the cash flow perspective, and maybe it's more appealing to a certain type of investor who really don't care about the IRR and more about the cash flow aspect of it.
I see.
Yeah.
And it bothered, on the Neil's thing, when I looked at just, and that's Cincinnati as a whole, looking at the population from 2000 to 2017, it lost 9% of its population.
Exactly. Right. Right. That's the first thing I noticed. However, as I said, we can't say, okay, because it failed that we passed the deal, because Neil's interest area might be Class B, right? So, and he also wants to make sure that there's a tailwind. But apparently, this deal is actually, the selling point is different than Neil's thing. So we can't say because it failed Neil's standard, then we don't need to analyze it. We still need to analyze. It's just they are making money from a different point if we check out the fact. Right. So that's the whole thought process. Okay. So let me continue the my thinking process. Right. So we will take a look at the supply and demand dynamic and how does it affect the rent and the vacancy, right? So, and also worst case scenario, can we survive 2008 and 2010? For whatever reason, that market seems to lag. So looks like the bottom is like 09 and 2010. And also very important, do those sponsors have good track record and have they experienced a full cycle, had some experience with these type of like property in a bad neighborhood? So those are the questions I try to answer, but not necessarily have answer for all of them. So first, let's jump into the location. So basically, this is the property. This is downtown area. We will see downtown area. There are a lot of construction going on, a lot of new property deliver or going to be delivered in the next 12 months. But only two properties recently being delivered in this area. So you will see it's not much going on. Like a developer, they don't want to go to the area. This is called Northwest Cincinnati submarket. Okay, the first question, is the current rent below the market rent? So this is, the blue one is this specific property. So it has 50-50, one bedroom and two bedroom. The average is 0.94 per square feet. And the others are the rent comes that's picked by CoStar. I also did the same thing with eNodo and the same thing with Renometer. They have different data, but pretty much tell the same story, that not much can be added to the current rent. It's not like significantly below the market rent. That's what the data tells us. It probably, for one bedroom, I think it can maybe, according to eNodo, maybe we can add another $50, definitely not 100. And I don't see it for two bedroom. It's probably just $10 difference. So different data source suggests roughly the same story. So that's one thing that I noticed. It's not what they said in the call. Maybe they have different data. I don't know.
What you need to know is is what the return on capital improvements is, and also to look at return on capital. How they're going to put 1.75 or whatever the total cost is they're going to put into it of improvements.
Yeah.
And then from that they anticipate these increased rents. So then it would be interesting to see what that return is on that investment.
Right.
And then when I look at this and I see 0.94, it would be great for us to be like, well, we think they might only increase rents $50, not $100. So really the return on this capital investment is such and such. That's an important metric.
No, actually this one, the 0.4 is assuming you don't do any improvement.
Okay.
It's just, like replacing the PM so that you can bring your current rent to the market level. That's it. We're not counting any like a renovation or anything like that. That's in a separate section. So the second thing is that, okay, what about we reduce the vacancy rate? So for this one, I actually get two vacancy rate. One, CoStar says it's 9.9. And I think I also read it from other report. It's about 10-ish. However, I specifically asked Rob. He told me that it's 6%. It's not quoted in the PDF. He replied to my email saying 6%. But if you compare to the rent count and compare to this, this is the submarket, this is the city, you will see it's actually already better than the rent count. This neighborhood had very high vacancy rate. So it's not like doing worse than the rest of the world. So I don't think that by doing nothing, you can actually reduce the current vacancy. So that's the story.
So 10% is in line with the sub-market vacancy already, and there's
Exactly.
nothing which you can organically do. Okay.
Yeah, exactly. And even better than the rent comp. The rent comp is actually whatever they pick from the submarket, right?
So it's
yeah.
like the only way it could go is down or increase rather. You're
Yeah,
saying.
yeah.
Yeah.
If you do nothing, then
Yeah.
Yeah, I also want to point out, looking at the trend line between 5-year, 3-year, and 1 year. Just looking at the blue box there, it looks like it's actually increasing in terms of vacancy.
Okay.
And look, it's bouncing up and down. Like now it's
Exactly.
10%. Last year it was 1.5. 2 years before that it was 8. 2 years before that was 3.
That's
Crazy.
exactly the point of these two charts. I don't know what's going on with their PM. So one thing I can say, although, for example, right now you at the 9.9, you don't see a lot of value by bringing down the vacancy compared to the rent comp. One thing we can say is that, okay, by replacing the PM, at least you won't see this huge jump. You see this blue line? This is the effective rent growth. Only this property, you will see this huge jump. Anything else, regardless it's the rent count or this sub-neighborhood or this city, you don't see that huge jump. So
I wonder why, like, what was the cause? I know we say property manager, but like, what's
Maybe I wonder if they give like we'll give you first month free if you move in, and they do that every couple of years or something like that.
I do see that. That's called conception, right? So that conception is actually most recent 2 years. Actually, it's in line with other property, but before it's pretty high. But we observe the same thing in the submarket as well. So
it's kind of inverse of what I would expect, because if you look at the 2017 to 2018, I would expect a higher rent growth to correspond to a higher vacancy, but it's actually the opposite, where you have less rent growth and higher vacancy, which is even more puzzling.
Yeah,
okay, great point.
I wonder if that's.
I also talk about that in the later chart, but this probably is just mystery. I don't know what's going on.
I feel like it might be driven by population. Is there actually less people or more people has a demand for it, the rent grows? So it's the driver is actually by the population, not necessarily by the management's action to raise or lower rent.
No, I don't agree. The reason is because look at this green box. These green box are the rent comparables, right? So they're in the same submarket, same neighborhood, and they are also 3-star, the most comparable to this property. Why you don't see the huge jump for those comparables, right? So
Yeah.
same population.
I agree. The jump is still too high.
It's like they overshot and then undershot, and then it's like slingshotting. It's like they don't know what the rate's going to be.
So
It's going to be caused by something else, of course, as a responsive measure.
Yep.
So going to Yan's point about the property manager, like, is it fair to say that given the data lines that this would appear to be property specific versus submarket specific?
I would think so, yes.
And all the other colors are like kind of stabilized or trending together, whereas this property is like kind of drunk or something.
Yeah,
Yeah.
That's good. That's good. And then
exactly,
for those that know Rod and Rob, you know how Neil, like if Neil was taking on this project and this is like going on, Neil's so like systematic and regimented and so forth. He would have this like whipped into order like in no time with his 100 virtual assistants and all that. The question I have is, as operators, and just for those who know these guys, are they like, would you be confident that they would like, be like drill sergeants and get it marching?
That I have no idea. That's why I'm so keen to find out their background. But we definitely need to hear from like an insider who have been invested with them. I'm sure that if we dig deeper, we probably can find them, because one claimed that he had 40 years experience. Another one claimed that he had 20 years experience. They must have a lot of previous investors.
So,
Yeah.
but they haven't been doing this for that long. Like Rod Cleef, back before the 2008 crash, he was doing, and he got like sued for one of these because he was doing rent to sell, and people weren't going by the contracts, and so he'd repossess the houses. So he had like 200 houses, single family homes, plus some smaller apartments, and most of his single family homes. Anyway, he lost them all. He lost everything in 2008. So he does have a lot of experience, and he's been through a bad cycle, and I'm sure he's learned a lot from it. But at that time, he was doing mostly single family homes in smaller houses. And, he had them leveraged very heavily, and they all depended on each other. And he said if he would not have leveraged his apartment buildings with the single family homes, he could have saved the apartment building. And the houses were empty. They were mostly occupied by construction guys and painters, and when the market dropped, they didn't have work and they couldn't pay the rent, and they left.
Oh, that's
Right.
Yeah.
So he did apartment actually before '08, but the syndication is relatively new. Is that right?
He didn't mention syndication on those, so I'm thinking yes. And actually, that's something I found for a lot of these people, like Neil Bawa. Even he's only been doing syndication like less than 5 years. It's very new for a lot of people.
Yeah, that's fair.
Although Joe Fairless, I have a few short slides. After you get finished, he has a lot of experience. He's been through 7 properties full cycle. So,
but Joe Ferris, I listen to his podcast a lot. He's actually a marketing guy, to be honest.
I think so. So.
He's not doing the actual work. He's just partner with somebody. He's doing the interview every day. Yeah.
I don't listen to his podcast because I think I listened to one and it wasn't very substantive, but he does one every day. So he doesn't, he's doing the marketing. Yeah.
Yeah. That's his role. And also you mentioned that the thing that the Rockcliffe, his tenant is most likely construction. So that also bring this, I also want to share this. So basically, these specific neighborhood, those are the ranking of their professional. So the thing that I highlighted as bad is the one that probably will get hit when economy went down. So yeah, construction, manufacturing. So if you sum them up, it's like 40-ish, 40%, something like that. Okay. So
There's one thing about Cincinnati is people do drive to work, like they drive, but I don't know necessarily, like in the Bay Area, people drive hours or whatever.
This specific property, they said most of the people drive less than 30 minutes. So that's okay. Yeah, that's not bad.
Who said that?
I think in this report mentioned that, yeah.
Okay, not the sponsors, some other report.
Yeah.
Probably neighborhood scout. Yeah.
Yeah.
Okay, and then of course, then if 70% of the people are single mothers,
single mother plus single. I think I just hover around and I show you beforehand.
Where I was going is that single mothers may be even closer to the home because they have a kid. And they can't if the kid's in nursery or daycare close to the apartment, they're not going to be 25 miles away.
Yeah.
Yeah.
Yeah, it's not
question on this neighborhood scout looks very interesting. Is that a paid service?
Mm-hmm.
Yes.
Yeah, it is.
Looks very cool.
So here, so single parent with child, 35%. Single, almost 40%. So these two are already 73. And then the one that I mentioned, the education, attended school, 3%. And then I think there's another one says graduated. So if you sum them up, definitely this is not a neighborhood targeted to graduate.
What's the poverty rate in this neighborhood? Income and poverty? I'd be interested in looking at
income. Household income is less than 30K. Some data even at 20K. Yeah.
Oh wow! And I think the OM had it at 38K. Are they bumping up those numbers? Or?
38 is for the neighborhood or for Cincinnati? That we need to.
Oh, I see.
It's probably for the city. If you could go back to your Word document, you had some demographics data in the very first page. I think you probably would see that. I'm just guessing. But you see,
There
but
also
It's
may
also
be
for
some
the
delay
county.
because I've noticed
oh,
that
it's even higher. Sorry, but
when I was analyzing another deal, like what it said on city data, city dash data on the map when you get down into the neighborhood, it was lower than what the sponsor was telling you. So maybe they're pumping it
Yeah.
up, but maybe the city data is a year out of date. Like if
Right.
The
it's
city
only
data
got
is 3 years
2018.
late, I think.
Yes, so it
Yeah.
could be that could be changing.
Yeah, but I think all the data that they mentioned in the PPT, the PowerPoint is actually Cincinnati for the whole city. They're
Oh,
not
wow.
specific to this neighborhood. I don't think they talk about the
they
neighborhood.
can't just it's just so bad.
Yeah, exactly.
Right.
Right. So yeah, okay. So let's go back.
But that's kind of misleading, right? Because the city could have a higher income level than the sub-market, and
Yep.
that's the only number they show. It's yeah, I wouldn't be happy if I knew that the sub-market had like 25,000 versus a 38 on the OM.
Well, I think if you don't know the difference,
Right.
then you will be misleading. But they are trying to sell you the story that they said, okay, this area, downtown area, is gentrifying, and they call it this area. It's actually a different submarket, but they call it this is the border of this whole thing. So they are saying that this will eventually spread out to here. So that's
really
the story.
misleading.
Will you believe it or not? Right? So yeah.
That takes a long time.
Right.
So-
I'm glad somebody said that. Like that can take, could be
Years.
5 years. It could be like generations. And in a
Yeah.
city like
So it's a
Cincinnati,
judgment call.
I think it's more on the latter.
Yeah, it's a judgment call. Anyway, let's get back to this one. So basically, I think even though not bring down the current vacancy rate, replacing the PM will stabilize the whole thing. I think this is still a good thing. Okay. On the other hand, can we do the same thing at the same time? So basically, talk about, I think, Jim's question saying that, okay, this is mysterious. We should see some correlation between rent and vacancy, right? So this is what I plot, right? So this is for all the rent comes in this same neighborhood. Over the years, you should see, okay, if you increase the rent, your vacancy will definitely go up. So you can like trade off the two, but you can improve on both sides, right? So this tells you the story. You can't say, okay, I can improve the NOI by increasing the rent and then also reducing the vacancy. Unless you are extraordinary PM, I don't believe that story.
Yeah, unless that or your area is gentrifying like crazy and you're improving the property like crazy, but just having a stable population, stable job growth.
Yep.
I think you have to trade off. You're right, yeah.
Yeah, exactly. And also, if it's gentrifying, it should be also reflected in this rent comp already.
Sure.
But yeah, I don't see that. Okay. Another thing, can we reduce the expense by replacing the current rent? Because we say, okay, if we cannot increase the revenue, can we reduce the expense? So this is their projection. So basically, I take their total rent, everything included, total revenue, and then total expense. Know that this expense does not include any capex, just the repair and maintenance, and then everything else. So this one, the ratio is around 50%, their projection. If I add the capex reserve back, it will go to 52, 53-ish. Okay, let's say these are the actual expense over effective rent across this different submarket. So we belong to this number 10, Northwest submarket. It tells you that 60%.
Wow.
Know that any vacancy is not reflected in this effective rent, right? So this only take out the conception part. If we also take into account, okay, there's 10% vacancy there, this ratio goes even higher, meaning that for whatever $1 you earn, your expense is 67 cents.
Wow.
So I would think that projection is very optimistic compared to the same submarket. So yeah, and you will see this. This is all the submarket, and then you will see this is pretty bad. It's roughly like a bottom two, this submarket.
Hey, Yan, can I ask you how do you determine the 60% for the I think it's in the CoStar. I'm just
Yeah.
not familiar with. Okay, maybe I chat offline and see how to find this information.
Right.
It's a lot of thing in there. It's 100 pages report, so it's got to be
Yeah.
somewhere.
Right. So basically, I gone through the data from 3 different sources. Like if it's rent-related stuff, I get it from Enodo, CoStar, and then also Redometer, right? So I don't want to cross different report because their statistics might be different, right? Because the way that they calculate it might be different. But I do want to say that the story they tell are consistent. If you look at the trend or the conclusion, these property compared to the rent comp, compared to the submarket, compared to the city, the conclusion are the same. So all the numbers I quote here are from CoStar. So so the data is all there. I just presented according to my question, right? So because I start thinking, if I want to make this deal work, what do I need? And I look at the data and then organize in a way that can answer my questions. So yeah, so the raw data are all there, right? So another thing is, okay, by bringing the new PN, can we improve it? So the PN's name is mentioned in the PowerPoint. I look it up. It's a really good nationwide good PM for sure. Although one thing I want to point out is that they are big in Tennessee, I think. But in Ohio, it looks like they only have 11 property and only one in Cincinnati. And then it's 10 miles north of this property.
And how about Kentucky? Because I think Cincinnati borders Kentucky.
It
Right.
does.
Right, that's right. So on their website, you can see different properties by state. I didn't specifically look for Kentucky, but even if it's in Kentucky, I would like to point out the border is actually in the south, right? So that's also far from this specific property because this property is in the north of downtown. The border with Kentucky is actually should be south, right? So I would say that first, they don't have the scale in the city or in the neighborhood. Second, it's also far. If you have a property like a 2-3 property in the same area, that will be easy to manage. But if scattered around, then you probably need to assign like a one person here, one person there. It's not very efficient. That's what I want to point out. But looks like they do have like a cooperation in other properties in other states. That's why they chose them. I'm sure that it's very good PM, but it's just they are new to this this market, I would say.
So they're new to this market, and didn't you say, I forget, I was looking at something in the PDF, that they primarily focus on more luxury properties or higher end properties?
Oh, so that's a judgment call. So I look at their website. So for each property that they manage, they show a picture. By simply looking at the picture versus the picture that's shown in their PowerPoint, I feel like those property are nicer. But it could be just like they take good pictures. It's a judgment call.
Because I have to tell you that, I mean, having lived in places and worked, with a whole range of demographics, that's a very unique demographic at Mount Airy, and
Yeah.
so you would want a property manager that's has experience
Exactly.
with that.
Exactly. Right. That's
And
why
while,
I looked
and
it
while
up.
Kentucky's not that far away, you know, you would want that. It's going to need a lot of hands-on attention to take all those squiggly lines and those graphs and make them straight, right?
Yes.
That's
Yes.
hands-on. And if you're used to like dealing with, you know, people who go to professional jobs and all that kind of stuff, like, you know, then all of a sudden they have a big learning curve, which is the investor.
I totally agree with you. That's why I go to their website, try to find out the property they manage is Class B, Class A, or Class C, but they didn't mention that. I'm just simply looking at the pictures. It looks pretty nice.
Yeah.
Yeah. Okay. I forgot they mentioned it here. Starting with ELIMI something. I forgot.
Yeah.
But you can look it up on their website. Very good website. Okay. And another thing is what happened to the deals that closed most recently in '08 and '07, right? So as I mentioned, this specific property has 50% one bedroom, another 50% two bedroom. Let's see what's their rent increase, assuming they have some business plan to bring the rent up, right? So, okay, the one that I put the box next to it is the one that just finished, right? So this transaction closed in last year this time. So, okay, it did increase by 12%, 13%. Those are really good, but those are the two exceptions. And the other three, not much going on. Probably is still relatively new. And then another thing that you want to take a look is what is their starting point? What is the rent per square feet? This one bedroom, they started around like a one. And this specific property, according to their PDF, it says one bedroom is $1. So it's already similar. So these two are really great. But looking at this, I think the property may be already very good. That's why they have this higher rent. I don't know. Okay.
And were those, I'm sorry, Yang, were these in the similar neighborhood?
Yes, these rent come out in the same neighborhood and also similar. So that's why CoStar said, okay, those are the rent comes. Yes, and then also I cross-check against what they said. Not all of them, they classify as their rent come. Like this one actually appears in their PDF. And then this one as well, this one, and then this one. So I think they picked 6. And in eNodo, when I calculate the rent count, I actually use their list, and then it tells me that the one bedroom probably they can increase by $50, but two bedroom only can increase by $10, even using their list of comps. So yeah. So okay, for two bedroom, same story. Let's see. So this is 16%. Again, these two are doing really good, and the others are doing okay-ish. And the starting point right now for one bedroom, the medium, two bedroom, the starting point for this specific building is 0.88. So they want to increase more. So 1.88 looks like similar to this guy as well. So maybe a little bit higher. I don't know. Yeah. So that gives us some sense like what happened.
So there's some room to grow on the 2 bedrooms, not so much on the for 1 bedroom.
Yeah. Okay. So another thing, okay, let's say we don't improve on the NOI, can we buy it cheap and then sell it at a fair price, for example? So this is for the submarket, 3-star. It says the rent come is 7.5. I don't recall they specifically mentioned what is the cap rate in this deal, but in CoStar they mentioned something like this is a 10% or 15%. Let me see here. I think either this refers to this building or refers to a even smaller neighborhood. It says 15, but I think this maybe for this specific property, that's why it's 1, but
Yeah.
I'm just guessing. And they don't even mention the cap rate in their PowerPoint. At least I didn't find it.
You know, we could probably call CoStar if somebody knows somebody there and ask them what that building is.
I think it will be easier to directly email Rob. But the thing is, so I watched their video on Saturday, and then I emailed him some questions. He emailed me back right away. But then on Sunday, I emailed him. I said, can I get the underwriting stuff? If you don't send me the Excel template, it's okay to just send me some video, right? So he said, oh, the macro crash, so he didn't send me. I said, oh, that's fine. You can just copy paste as value. I don't need the formula. That will make your like Excel spreadsheet smaller. And then he didn't reply, not even today. So that might also tell you some story. So yeah, there's no underwriting there. And then in their template, they only go through the assumption. So I don't know how they come up with all those calculations. And then I certainly cannot replicate what they do because I don't know the number. So that's just a benchmark to tell you, okay, what is the cap rate?
I wouldn't rely on the 15% because it could be one deal which could be a distressed property.
Yeah.
And yeah, so that's not going to give us a lot of information.
Yeah,
but,
exactly.
Yeah.
Exactly.
Mhm.
So for example, this one might tell more story. Like
Sure. Yeah.
average is 9%, and then median is 8.8. I think that below we have a trend. I think I believe that one. So this is U.S. versus Cincinnati. The trend is the same. Cincinnati here is around like a 7.5-ish. So yeah, and then also for this specific Northwest neighborhood, we also see the same trend. So from 9, now it's 7.5-ish. But I think this one is a little bit higher than the city. So that makes sense because it's a worse neighborhood, right? So
I think so. He's buying probably at close to market, right? Because I think he mentioned somewhere around 7.5 in his deck. So
okay.
Not getting a significant discount.
Yeah. Okay.
like he said he did something. Or he
Yep. Okay. And then we talk about the cap rate. And then, this is the interesting point. I spent a lot of time trying to organize the data to present it the way that I want to present it. So basically, huge bet. Do you think this neighborhood is up and coming, benefit from the downtown area, right? So, so I want to see if it's benefiting, at least you should show some trend that's similar to the city, right? So, what we can see is that, so city is the largest population, right? So the largest scope. Smaller subset is the submarket, which is the Northwest. And then a rent comes is even smaller one. And then obviously there's this specific property. So I would say that here, starting from 2016, it actually diverged. So the rent count actually becomes crazy, like a vacancy rate is around 15. So it's not good. It's not good.
So two things, right? Yan, just out the bat, if the area is gentrifying and a lot of people are moving in, then the population should increase. The only way that vacancy could increase at that point is new construction.
Yes. Okay. So that's a good point. We also cover the supply and demand. In this specific submarket, we don't see a lot of construction. On the other hand, in the downtown area, there are a lot of new construction there. So if anything, that your conclusion should be the other way around. We should see a lot of vacancy due to this one, not happen here.
Another thing that you could check is, I think Neighborhood Scouts has a 1 mile, 3 mile population change in the last 5 years.
Yeah.
that should give you a good indication of people's movement, whether they're going away or coming into the area.
Yep. Let's see. I think I do see those. Oh, by the way, this is the crime rate, and then hold on.
Oh, seems like it does have.
You can search for a half mile.
Oh,
The
okay.
search class.
Yeah, I think I do see it. Oh, okay. See here, half mile down by 11%.
Oh wow,
The population, right? Yeah. Okay, and then 1 mile down 5%.
explains a lot, right? Yeah, 10%
Yeah.
of the population. lost.
3 mile actually increased. However, I go to city data, and then you know that Neubauer show us like how do you show the specific neighborhood, and then what I see is that around this specific area, it's actually, I don't know what's going on, but if you look at the income, actually just slightly change it a little bit, it's increasing by 40%. If you move a little bit, it's like down 20%. So it looks like it's in the border of something, but I don't know what's going on. It just like hypersensitive.
I see.
Yeah.
There's another tool that I generally use called justicemap.com.
I also go to that one. Yes.
Yeah, you can check block by block as well.
Yes, I checked that. It tells the same story as city data. It's
Oh, I
very
see.
sensitive. You move the mouse a little bit, that will go from -20 to +40. Yes.
And what's that name again?
Justice map.
I can type it on the chat window, Mary.
Oh, thank you.
No
Yeah.
problem.
So yeah, I also look at that one as well. Yeah. Okay. On the other hand, we want to see, okay, is the rent going up? This one we do see like same trend, which is good. However, at the cost of increasing vacancy without new construction in the area. Okay, so this is at comparing the sub neighborhood. We can see what is the inventory. So basically, inventory tells you, okay, in the current market, how many units available in the market. So total sum up equals to 100. So these northwest is like maybe number 3. Like this is number 1, number 2, number 3-ish, number 3, number 4, 13%. And then effective rent here, the growth is 4%. And then see this, this is 0.86, which is lower than our current one. Remember that 1 bedroom is $1, and then 2 bedroom is 0.88. So this one is actually lower than our property. And then rank it number 7. Vacancy rate is crazy high. It just jumped up 9.9 compared to any other stuff. And then expense is 60%. And then that one, I think I just showed that, right? So 60%, if you take into account the vacancy, that's 67%. That makes sense because it's bad neighborhood that expense is higher, right? So yeah. So that's the comparison. So if anybody will benefit from the gentrifying, I think this neighborhood is probably the last on the list.
Right.
Yeah, so that's what the data tells me. Demo trend, I think, yeah. So we just see it here. At least this specific neighborhood is actually going down. Although there's something good happen, like further, but don't know what's the reason there. Probably crime or whatever. So people don't want to move in. Those high income or highly educated people, they don't want to move into that area because it's bad income. It's just one possibility.
Sure.
Okay, supply and demand. So this is a timeline. So you can see a lot of going on here, underway or proposed is 2021. That's next year. And then this is the numbers. And look at this. Okay, let me shrink a little bit. See here, a lot of them are here. That's the downtown area. In the same neighborhood, only 2. So it shouldn't, the vacancy shouldn't be like explained by this. And
Do we know what those developments are that are built or being built in the area?
Say that again.
You know, the 2 developments by the Mount Airy apartment. Do we know what they are? What type of developments? It's okay if we don't. I was just curious.
We do have the data, but I didn't present it here. I can send it out later.
No, don't worry about it. Don't worry about it. We can get to it later if it's important.
Yeah.
Yeah.
Okay. So, and also we try to see, okay, what is the dynamic between the new supply versus the vacancy? So just give us some idea. So I would say, if it's for new construction, obviously it doesn't apply to our property, but yeah, you see the vacancy at delivery is pretty high. So that means for this new construction to fully rent out, it takes time. That also means that because right now there's more supply on the market, it will also affect our property as well. If there's any impact, that will be negative impact, because imagine I have a new building, I cannot rent it out. So what I will do, I will give more concession, give 1 month, 2 months free. Then okay, then probably if yours is next to me and then you are the old building, what you're going to do, you're just going to give out more free months, right? So you can just infer that, although we cannot quantify the impact. Yeah.
That's
okay.
significant.
Right. So this one, I do want to get a sense, what is the worst case? Although the data here is not a good measure, but yeah, probably we just need a different data source. So this one, I simply use what is the price at that time versus right now to give us a sense. Let's say crazy thing happened, then we just drop to 2009 level. So how much you can lose. But this is a crazy idea. Just give you a sense. This is not a good measure, but this is a good question. It's just we need to come up with a better measure to answer this question. And then, okay, Wu Jie couldn't dive in this time, but he did a pretty good research on this one. So basically, I tried to find out, do they have a track record to manage this type of property? He actually did a pretty good job, give us a lot of background information, but not necessarily directly answer this question. But we can all take a look at it. Okay. So he has CPA. That explains why he can like talk about a deal like in a very like logical way, which I like. And then he mentioned this 20-year experience, managed 1 billion. Yeah, and knows about the tax, something like that. Yeah, in construction, whatever. So he's been involved in 3 companies, and then good news about it is that he had a lot of projects working with Rob, which made a good team. And he also mentioned some properties on the website. But the thing is, how many properties are like this? That's the key thing I want to find out. But I didn't have time to go through all the properties on the website to see whether it's similar to this situation. So this is the conclusion from Wu Jie. Yeah, more like a numbers guy. Then 4 deals, no evidence was the Lee sponsor. Yeah, and he also raised a question saying that only 2 members. What happened to let's say one guy gone? Then what's the replacement? Something like that. Okay, that's pretty much it. So yeah, any questions or some thoughts like what we can do to give us more like confidence in this field?
Yeah, thank you for the presentation, Jan. I mean, it was really informative, dug deep. I think you've cross-referenced a lot of data from different reports.
Mhm.
Definitely not a small exercise. Thank you for that.
Yeah, exactly.
Yeah,
It's really
yeah,
terrific.
terrific.
Nice job.
Yeah, I literally just finished it like 1 minute before this presentation. And I started at like a Saturday night. So yeah.
Well, I
This
think,
has been
yeah, I think you also asked a lot of questions like deal sponsor itself, meaning, can I increase rents and maintain vacancy together?
Yeah.
Are you getting it at a discount? And, to me, it seems like it's a very non-gentrifying submarket, which does not have a lot of potential to increase rents, whether it's the 2-bed or the 1-bed.
Mhm.
Also, the vacancy is already at or better than the submarket.
Mhm.
Plus, it looks to me like a speculative investment, and purely based on that, I wouldn't probably invest in this.
Mhm. Yeah.
Yeah.
Yeah. I would think so. If it's in downtown area, probably the gentrifying theme might play out, but this one just seems too far from the downtown area.
Right.
I put together a few slides on
oh,
the
yeah, yeah.
Yeah,
Ashcroft.
Mary, please do. Yes, we want to
So,
talk about
so
the
I am
nickname.
like terribly embarrassed after seeing what a detailed analysis you did. It's beautiful. So this is very high level. So if you'll stop, I will. If you'll stop showing, I think you have to stop first, and I'll try to figure out how to show.
So let me stop sharing right now, and then you can press the sharing button.
Okay, great. Thanks.
Okay.
So this is one that just came out last night. It's I'll just go through. So when I was listening to somebody online, I can't remember who it was, the pilot guide, Jim Beam. He's a pilot guy, and he says first go with your team, look at the team. Second, go with the market, and third, analyze the property. So, even when I'm looking at Neil's, and I'm a Neil guru, like I'm drinking that Kool-Aid. I love, what Neil does, and I'm a big believer. But even 5 years ago, he invested in Chicago, and he's still not, and Chicago is terrible. You can't evict somebody for 9 months, but people don't have a long history. So anyway, these guys have like 20 properties right now, valued at 90 million. There's other people on the team, but I didn't really, I just cut and snipped. This is very set. So they have 7 properties that have gone full cycle. They bought them, improved them, and sold them. The average IRR was like 30%. The lowest one was 22%. And granted, 5 years ago, you could buy much more profitable apartments. Now the market's much tougher. There's lots of people buying them, but they've got like 7 that have gone full cycle, and that's pretty unusual. Like I don't know that I've seen that with too many. And so this one is Overlook Ranch. It's in Carrollton, Texas, North Dallas, 580 units. They got it off market. It's got a good school district. It's kind of interesting. He said there's higher rentals, like 60% rentals in this area, as opposed to overall Dallas is like 43. So they thought that was a plus. Okay. Population's supposed to grow a lot. I don't know where they got this data. I got it right off their thing, like 3 times the US average. So really good. And in my download of information from that US website, Texas was tied for second in jobs growth over 10-year period. They were at 20. Highest was Utah, 30%. Then Colorado and Texas at 20. So it's a big job growth market. Here's the place right here. I was looking to see, hey, is there a Starbucks right now? Because that's supposed to be the gold, the gold symbol. If you're within a half mile of a Starbucks, it's great. No Starbucks, but there's some, there's an Applebee's, there's some so there's some national places. So not great, but it's really also close to this. You can't see it here, but it's right close to the highway, so you'll get a lot of views. So that'll get, like the one that I invested in Dallas with Rod and Robert. They said it's a big selling point if it's right by a expressway, because you don't have to spend as much money marketing it.
Mhm.
You'll have people come to buy all the time.
Yep.
And here's the offering summary: general, cap rates, expense ratio 51%, 89% occupancy, kind of low. So I ran it through Neil's stuff. Here's Neil's stuff. This is Dallas, only meets 3 of 5 of the city criteria. It's a little bit low. It's only like 13% on population growth. They want 20%. This is from 2000 to 2012. And income growth was not quite enough. They want 30%. They're at 26, but it meets the other 3. So it's good. Then I did the drill down to neighborhood data, and it meets 4 of the 5. They want income between 40 and 70. It's at 41. They want rent 700 to 1,000. It's below that. It's 600. They want unemployment no more than 2% greater than the whole city, and it meets that. And poverty, they want less than 15%, and they want a mix of ethnics. So it's like 55% white, 15% Hispanic, and then it looks like 15% black. So good mix. And here's like interior renovations, what they're going to do. So, you can tell these are like late 80s cabinets. I remember those specifically. So, it's 6,200 per unit. They'll do the usual outdoor improvements and such. But the part I really like is the returns are kick-ass. So they have a 2-level thing. So if you want to take out 10% a year, you can. You get 10% a year, but you get nothing when they sell it. So you get a flat 10%, and that's it. That's class 1, class A. So first is the debt with the bank. Second is class A, then they get paid. Third is class B. Class B is decent, 7 to 8 to 9. No refinance, but then they sell it. So, you're looking at getting, so your IRRs are like really terrific. I mean, like 10% here and 16% there. Almost 2 times your equity multiple if you do the class B. I liked a lot that these guys have gone through 7 properties full cycle. I like that they're in Dallas, big growth area. It's like in a good school district, and it meets Neil's criteria mostly. So anyway, that's the extent of what I did. So Yan, you put me to shame, but I thought I'm very excited about this deal.
Yeah.
You have the link to that. Do they record a webinar?
No, webinar's tomorrow night.
Oh, tomorrow night. Okay, so can you share the?
Yeah, let me see if I can figure that.
I think I might have sent it out this early afternoon. It's just a phone number. I didn't see a webinar link. It's just like a call in and dial number. But then they did send out their investor deck along with that email, so you can download that from the Dropbox.
Yeah,
Oh,
I didn't.
Okay.
I didn't get.
So
to
you
that.
say you sent it out this afternoon?
Yes.
Oh,
Check
okay.
it out. So the cost tomorrow, I don't know if we have the time, or maybe we can, I don't know, do it on the weekend or maybe early next week to debrief
This
on
is
that
one,
one.
yeah.
But it feels like this one is probably gonna get sold out pretty fast, knowing Joe Fairless is almost the king of syndication, kind of like in the same
Now, and they
level
also
at
have
Breast
lower
somewhat.
amounts. Like if you're going to do Class A, if you're a first-time investor with them, the minimum is 50,000. If you're a repeat investor, 25,000. I was pretty surprised, but they did just sell some deal, and so some of those people are going to 1031 into this. So I think you're right; it'll sell out fast.
Yeah.
I already gave them a soft commitment. I said, yeah, I'm investing. And, at that point you can always, they have to get more than they want. It's soft. There's no commitment. I haven't signed any papers, but I wanted to get in line.
So it is like a fixed income type of thing. So regardless how they perform on the renting, you always get 10%. Is that correct?
That's right, as long as they have enough money. So they've got to pay the bank first, and second,
Oh.
they pay Class A. So, but Class A gets, you know, they get paid, but yep.
Yeah.
It's-
It's
So,
like a
like, for
mezzanine
example, I
debt.
talked to somebody who's living off his investments. He had some real estate, and he's a youngish guy. His name's Travis, and he's associated with them. And he always does this one. He always does the 10% because that's what he lives on. So he likes that.
Like
And it's
mailbox.
got much lower returns. Like, look at this.
Hmm.
So what is their business plan? It's just simply doing some interior renovating. Is that right?
Yeah, I think it's kind of the usual what I hear for value add. I just put this one up there. I didn't even do it. You know, they're going to do some exterior. You know, usually exterior is a big thing. New signage. Sometimes people paint. I didn't even pay attention to what they were going to do. Exterior, but they are doing some exterior. You know, when you look at this versus this, that's a big difference. It's just a difference in the way it looks. They're going to do stainless. That, you know, they're going to do. So interesting here, new wood style flooring. So they're kind of selling that at the luxury vinyl plank flooring. They're selling that as an improvement over the old wood style flooring, which to me, give me oak floors any day. So I guess I'm surprised that they consider this a plus. Maybe that's sales pitch. I don't know.
There seems to be a lot of newer construction also put in the same LVT. I guess instead of refinishing the hardwood floor, which would cost a lot more, and then they stain it and they just slap these plank on and they scratch it, they can just throw a piece away and put it back on. So it's both from a cost perspective, but it still looks decent.
Yeah, it does. It does look good. So, you know, the usual value add, they're not doing any refinance. They're just, they're getting a 5-year loan at 4.3%. I don't think I put that in here, but so 4.3 is a pretty good rate. But, you know, when I'm listening to other people, they're like, yeah, we don't want to do 5 years because, you know, eventually the crash is, you know, the next recession is coming and we don't want to have to try to refinance there. So interesting that they are, you know.
So I don't quite understand that. Let's say you are the sponsor, right? So what are the consideration when you decide whether you want to refinance or not?
So I think like in that other one I showed you, where was that one? Here's the one. So this is like the Rod Cleef one that I'm in. And they refinance, I think, to pull out some money. So when they refinance, that money is not taxable, is my understanding.
Yep.
So you get that money and you don't pay tax on it.
Yeah, and then you also get return partially of your capital, so you can use it somewhere, or just make your IRR looks a lot better.
Yeah, that's right. It makes your IRR looks a little better. What I'm a little surprised here. So if they take out this refinance, they're going to have a bigger loan. And then right there, they're going to give out more cash. So it's a little surprise, you know, I guess it's a little surprising to me because like on Neil's deals that I looked at, once they did the refinance, they, where'd it go? It went down. So here it is. Here you get a big refinance here in year 5.
Are you showing something on screen? Sorry, Mary.
We can't see anything.
You
Oh,
probably
you
have
can't.
two.
Sorry.
You probably have double screens. Another screen.
I only have one screen on.
Oh.
It says
Just show up.
I think when you share, you selected only sharing the PowerPoint instead of
I
sharing your
see.
desktop.
Okay, let's go again. Let me try again. Share. Let's see. Share screen. Let's do that. Share.
You're sharing Vivat.
Okay. So now can you see this?
Yes, we can see it. Yes.
Okay. So this is one of Neil's deals. So it starts 0 in year 4. It starts low, gets in, you know, as they increase rents, it gets more. Here they do a refinance, and there it drops right down. That makes sense because you've got a bigger loan now, so you have less income to put out. But when you look at the Rod deal, it wasn't doing that. So I'm not sure why. So here's the Rod deal, 5%. It increases to 8, 8.5. They do a refinance in year 3, and your cash on cash return keeps coming out. Not sure I get it, but anyway.
No, I think I think in year 4, Mary, maybe they're computing the denominator as the portion of the investment still in the investment.
Ah,
Yeah, your denominator
Ah.
becomes smaller and smaller. So
It's,
it's
it's
there
a,
you go. You're right. So it's 85 there in year 3, and then in year 4 it drops to below 4,000. Got it. You're right.
right, but your base is also only 30,000 now, so
Yeah.
it looks like almost 10%. Oh, it is
Yeah.
more than 10%. Yeah,
yeah,
Ah,
3.8 divided by 30.5.
that's
Basically.
12. Yep.
okay. So anyway, that's what I had, but I just thought I'd show you what they had going.
Yeah. Have you?
Yeah, Patty
Okay,
just
sorry.
messaged saying the luxury plant is also waterproof and has better warranty.
Oh, thanks, Patty. That's right.
All right, gang.
All right.
Everybody, have a good night.
All right. Hey, thanks to all.
Bye.
Bye.
Talk again.
Take care.
Bye.
Great job, Ian.